Enough stuff to remember. For update for the Spears & Associates Drilling and Production Outlook, I'm John Spears. I'll be your host for the next 60 minutes. I'm joined this morning by Richard Spears, a man whose reputation precedes him. That's why he doesn't need to make dinner reservations. They know he's coming. So I thought Richard will be joining us on the back end of the podcast here this morning for the Q&A session. But Rich, I thought
that's my specialty on the back end. Thank you.
There you go. I thought you might tease us a little bit, tease the audience a little bit about where things stand in the world of finance for oilfield service firms, because I think that kind of sets up the discussion about activity and what we think is going to happen there. So we know that oilfield service companies are, generally speaking, broadly profitable, but don't have much access to outside financing. So what does that affect in terms of exit strategies?
Oh, golly. Well, yeah, and in big, broad terms, if you're a large publicly traded oilfield service company, you have already had access to capital, debt, equity, whatever, for a while now. Uh-huh. But the smaller you get, the smaller publics and definitely the private companies, access to capital has been a problem.
Post-pandemic.
Yes. In fact, ever since 2018. So so we're in year 5 now. However, there's some indications that that money is coming back into the market. Just an example, the Norwegian bond market has funded 3 oilfield service companies to the tune of about $250 million. These are all private oilfield service companies.
So this will be growth capital, I presume?
Think of it as it's growth capital. It's to replace really expensive debt. Okay. It's to put more money on the balance sheet. Yeah. It's not related to a transaction.
I understand. Okay.
You've got a U.S. land contract driller, private one, who actually got a $10 million working capital line. Okay. This is all expensive debt. It's still at 13%. But it is becoming available, and probably one of the biggest indicators that deals are thinking about happening is that next Monday in New York, so in a couple days, Bank of America Securities has a full day symposium with private oilfield service companies and the potential equity investors coming in to talk to each of them. These private sessions.
Get to know you sessions.
So think of it as a dozen private oilfield service companies, and I really don't know what the number is of potential private and hedge fund investors, but it's fully subscribed. So we'll be there for that one.
So everybody's going to show up with a shoe shine and a smile, like Willie Loman.
I'm going to have my. By the way, 2 years ago, zero interest. This year,
so
fully subscribed. So those are the early indicators that it's coming back.
Okay. Well, like I said, Richard will be back once I'm done with my slide deck here. So we'll have more questions, and we'll see you there.
And if somebody has a question, they can type it into the YouTube chat box.
Yeah, gotcha. Fair enough. Well, thanks, Rich. What could be bigger than the fact that Pat Sajak is about to retire from a Wheel of Fortune after 43 years in the business? I certainly appreciate someone who's stuck with the same job that long. But that's not the key thing. I think the key thing here is the fact that in the Cricket World Cup Championships, the U.S. managed to beat Pakistan in a game that is brand new to this country. I think the right phrase to respond to that is that news is enough to bowl a maiden over. So, but that again is not what we're here to talk today about. We want to sort through these headlines and really look at the factors that are driving CapEx decisions in the upstream sector of the business and what that means for near-term and mid-term kind of drilling and completion activity, both in the U.S. and around the world. So, and by that we want to measure rigs, wells, footage drilled, and so forth. For the first part of the session, I'll go through a slide deck that we've prepared that summarizes the current state of the market and includes our updated forecast of drilling and production activity. And then, like I said, we'll stand for questions on the back end. Richard already said that you can send in questions via the chat box here with the broadcast. We'll try and get those all answered before we end our session. Some folks have already taken the opportunity to send us questions directly to us by email. You're certainly welcome to do that. And if you want to, you can use the address sai@spearsresearch.com to send in any questions in that fashion. And then one final piece of housekeeping before we get started, and that is that today's slide deck and then the accompanying PDF file, Word document, and Excel files have already been sent out to our DPO subscribers. If there's anyone in your organization that is not receiving it from us that you'd like to have, let us know. We'll put them on the distribution list forthwith. So with that out of the way, then let's get started with our slide deck. So, we want to first look at some key macro factors and think about what has changed since we last met back in March. And so, of course, the news, we're now about 5 days past an OPEC Plus meeting, which they made the news from that meeting, having taken the decision to begin to slowly feed oil barrels that they've been holding off the market, feeding that back into the marketplace. Initially anyway, there was kind of a severe reaction on oil prices. Spot WTI fell from around 78 to around 73. But has since come back to, I think today's trading numbers are somewhere in the 76, 77 range. So yes, an initial reaction, but as time has gone by, things have sort of returned to the mean or returned to the pre-meeting level. And it's interesting to see why that has happened, because when the news came out that OPEC Plus was going to again return, feed some barrels back into the market that it had been holding off. That was in the context of what had been several weeks of kind of bad, worse than expected economic news, and which had triggered worries about a slowdown in oil demand. So a chart we're looking at right here on the left-hand side looks at what the oil demand, the change in oil demand as the Energy Information Agency, the EIA, has been putting out. Its most recent forecast calls for some growth in oil demand, up just shy of 1 million barrels a day this year to around 102.8 million barrels a day, so up 0.9%. So yeah, the growth numbers are down relative to last year. What's interesting to do is when you compare the bars on that left-hand side chart, what completely goes missing? Well, two things. One is that the Chinese numbers in red fall pretty sharply, about half the level of what they were a year ago. But the black part, which is our OECD nations, the developed economies of the world, so US and Canada and North America, Western Europe, Japan, Australia, New Zealand, comprise the countries in OECD. It does not include China, does not include Russia. But what you see is the black part of the bar, which was teeny tiny back in 2023, has disappeared entirely in 2024. So not that it accounted for very much of the growth in demand, but certainly the news that we've all seen over the past month or so that talks about slowing economies and so forth has really been very US, North America, and European centric. And so, yeah, those economies may be underperforming or be thought to underperforming relative to expectations, But that doesn't mean a whole lot in terms of global oil consumption. Oil consumption on a global basis, in terms of year-over-year growth anymore, is really focused on China, the gray part of the bar, which is other Asia, and then the yellow part of the bar, which is our rest of the world. So you get about 1 million barrels a day growth coming from those three areas, and entirely absent the developed economies. And then next year, forecast is for a pickup in growth, at least at this point anyway. And you begin to see, again, a tiny bit of growth in the developed economies, but not very much. The overall market, like it says on the chart, is up about 1.4 million barrels a day. So, the most recent news that just came out about the performance of the U.S. economy back in April is that in May, is that job growth and so forth beat expectations, and so that's helped lift oil prices because it appears that worries about economic performance in the U.S. are a little bit overblown. But the point that I would still make is that doesn't really mean very much when we think about global oil demand. So the fact that OPEC is beginning to feed barrels back into the marketplace, and that may happen at a time when prices remain fairly stable, really speaks to the outlook for oil consumption outside of the developed economies, and that's really what we're looking at here. On the right-hand side of this chart is where the change in oil supply is coming from in 2024 and where it is expected to come from in 2025. And the black part of the bar, of each of those bars, is U.S. So U.S. output is forecast to grow about 400,000 barrels a day this year. You're getting a fair amount coming from Canada, close to 250,000 barrels a day. The green part of the bar is Brazil. We've got Guyana counting for a bunch. So again, OPEC Plus as an organization is actually got a reduction in production relative to a year ago. And so the impact as they began to feed barrels back into the marketplace is really only felt in 2025. The OPEC Plus decision that was announced last week really was that it would only begin to resume or increase output in the fourth quarter of this year. So, of course, there's very little effect in 2024, more of an effect next year. The one thing I would call attention to is that in 2025, the EIA is extremely bullish in my mind as to how much increase in output is coming from the U.S. They've got the number up about 800,000 barrels a day or so next year for both crude oil and natural gas liquids. And when we go through our numbers related to the drilling forecasts and so forth, we only come up with about a 400,000 barrel a day increase. So I think the numbers in the EIA forecast are a little overstated, at least as it pertains for 2025, at least as it pertains to U.S. output. So we'll see if going forward those EIA numbers begin to get revised a little bit, but I think that's something to keep an eye on there. The other thing I wanted to call attention to is, while we talk about global oil production of roughly 100 million barrels a day, I think it's interesting to focus on how much of that's coming from offshore, because again, what we hear the major oilfield service companies talking about is that they see growth for demand for their products growing internationally and offshore. And so what does offshore mean? Well, on the oil production side, offshore output accounts for about 25% of the barrels these days. And that's what you see in the pie chart on the left-hand side of this slide. There has been very little change in that overall offshore oil production number for the past 5 to 10 years, interestingly enough. Some nations have increased, like Brazil and so forth, but other nations like Venezuela have seen their output fall. So this is oil production across all water depths. On the right-hand side, we just want to look at oil output from deep water fields. And so while offshore production in aggregate is about 25% of the market, deep water is about 40% of the offshore piece. So today there's 9.5, maybe 10 million barrels a day of oil production coming from deep water fields. And as you can see, the profile of where that's coming from is interesting to pay attention to, because again, if our fortunes as an industry are increasingly tied to growth in output, much of that growth in output is going to come from deep water, and so where are those deep water fields? Well, not surprisingly, about 40% of it is Brazil these days. They're producing close to 4 million barrels a day of deep water production. Norway's our next one on the list, about 1.5 million barrels a day. The U.S. is about 1.5 million barrels of deep water production. Angola's next. The UK, the up-and-comer on the chart is in the green slice there, 0.4 million barrels a day. That's Guyana. Guyana this coming year will be up another 200,000 barrels a day. Exxon has said that its plans for field development in Guyana will mean that it will be producing close to 1 million barrels a day come the end of this decade. So, and of course, Brazil's got plans for more deep water production. The U.S. has its own plans for more deep water production. When we also look around the world, there's places like Suriname and Namibia, who also have some exciting discoveries that are now moving into the field development process. And so you can certainly expect to see that if that deep water production number is close to 10 million barrels a day, by the end of this decade, it wouldn't be a stretch to assume that it could be closer to a 12 million barrel a day number probably, and then grow from there. In terms of the other macro thing that we pay attention to, of course, as it pertains to drilling activity or affects drilling activity, is what's happening on the natural gas side here in the U.S. And so there the numbers, as we all are aware, from a pricing standpoint, have been pretty dismal. I mean, at one point when we were meeting in March, the price of natural gas was trading around $1.50 per million BTUs. I think it bottomed at around $1.4 per million BTUs later in March. So it's been disappointing. Why has that happened? Well, gas inventories have risen tremendously. We didn't have much of a winter, and so as a result, domestic consumption, the red part of the bar, is expected to grow very little in 2024. We're looking at the latest numbers suggest that gas consumption is going to only be up 0.2% here in the U.S. this year, which is really interesting because the power sector is the biggest part of the U.S. Domestic gas demand piece. It accounts for, roughly speaking, 36% of U.S. gas use today. And while the power requirements are rising, both due to weather in the form of hotter summers, and then the expansion of data centers and Bitcoin mining and AI chips and so forth are really lifting the outlook for power requirements going forward. At least in 2024, the increase in power requirements is going to really be met by solar and wind to some extent. Natural gas will probably not see much demand growth from the power sector in 2024. At least that's the expectation at this point. So that's why the red part of the bar just doesn't move very much from 2023 to 2024, and really not even 2025. The incremental growth, at least over the near term, in the power sector is really being met by alternatives, solar and wind. Now, the black part of the bar are our exports. And exports are expected to grow a little over 3% this year, and then are expected to grow closer to 10% next year. Exports are both pipeline exports and LNG exports, and it's really the LNG piece which is powering the export numbers up both this year and next. So we're moving to a point where come next year anyway, we'll be close to 117, 118 BCF a day on average for gas demand here in the U.S. On the production side, the slide on the right-hand part of the page, again, we're looking at output from the U.S. Right now ending up somewhere around 102 BCF a day this year. It's down about 0.8% in aggregate, and that's because the warm winter left a lot of gas in storage, and So the summertime injection season is going to be disappointingly low this year, and in order to so that storage caverns might rebalance by the time we get into November, December, the start of the next winter round. So summertime injections will probably be about 20% below what they were a year ago, which they weren't great a year ago. But so the gas market's going to remain pretty loose through the third quarter and well into the fourth quarter, we believe. And so there's just there's just not the demand for gas from dry gas wells or associated gas production, and so the numbers are going to be pretty soft. Now, as inventories rebalance, we expect that gas prices will begin to rally, and that'll help. That's one of the reasons why we've seen gas prices recover from their low of $1.40 or so to now trading these days around $2.25 per million BTU. So this the changes that are taking place with regard to inventories and so forth has begun to put some support underneath natural gas prices, and that'll help things as time goes by. But as you can see from this chart, our numbers are not that much changed from those that we were using back in March. So for now anyway, we look that WTI prices, spot WTI prices, will end up averaging around $76 a barrel this year, just down a touch from a year ago. We anticipate that OPEC Plus, as it begins to feed barrels back into the marketplace, will only do so at the rate that sort of allows oil prices to remain stable. I don't think they're going to overrun the market with barrels and weaken the price. The big player there, of course, is Saudi Arabia. And Saudi, I read, the IMF has estimated that Saudi needs a price of around $81 a barrel in order to balance its federal budget. So I'm pretty sure that they're going to have that in mind as OPEC begins to return barrels to the marketplace. And so we think prices will stay fairly steady for the rest of this year at near current levels, and for in 2025, again, at close to current levels as these barrels begin to re-enter the marketplace, given where we think demand is going over that same time period. On the gas side, again, we're looking at a price of around $2.30, $2.35 for the year on average. Down from about $2.50 per million BTUs last year, so we're down slightly. The year as a whole, we think will be up a little bit from where we stand today. Again, if we've got the injection estimates right, then inventories should be rebalanced by the end of the year. That'll help support prices, and then at least going forward into 2025 should support an even higher price, assuming the weather cooperates, which at some point it will, and end up with a normal winter gas demand figure. So again, nothing spectacular in terms of expectations for gas prices, but one of the things I think it's important for us to keep in mind is that particularly in the dry gas basins of the Haynesville and of the Marcellus, the average operator in those areas needs a price of around $2.50 per million BTU in order to break even on their operations. So prices below that means that those operators will be laying down rigs. Prices above that will mean that there's hope anyway for rigs to return to activity. Of course, the vast majority of the gas that's produced in the U.S. these days is associated gas produced as we deliver oil to the marketplace, and so operators in those situations are basically selling gas for at any price, because the economics of their drilling program. The production operations really don't depend upon any certain gas price. So out in Waha, Texas, the center of the Delaware Basin, these days you see the spot price of gas trading at around 30 cents per million BTUs. They're just pricing it so that it finds a marketplace. And I think we'll see extremely weak gas prices even next year in places like Waha, where we're really talking about associated gas production, which is which is the producers there are price takers, not price makers, and can live with pretty much anything so long as they get to produce the gas and don't have to shut it in to either flare it or re-inject it. So that's our underlying estimates with regard to demand, supply, and pricing. And then the question becomes, well, how does that relate to activity levels? And so we'll start here in the U.S. and talk a little bit about what we think this means when we think of the traditional measures of activity. So rigs, wells, footage, and so forth. So we've lowered our numbers for the U.S. So rig count numbers now we think will end up averaging around 609 rigs for the year. Of course, today they are close to, sometimes a little bit above, sometimes a little bit below 600 rigs. And really what we've seen happen since we last met in March was that on the gas side, operators have begun to lay down rigs in response to these disappointingly low natural gas prices. So it's interesting, in 2023, same thing happened. We were coming off a year with pretty strong gas prices. As we see on this particular chart, we were well over a $6 handle in 2022. We're expecting prices to remain above $3 in 2023. When they didn't, operators began to lay down rigs. What's interesting was that the gas operators in 2023 waited until about May before they began to cut back on their gas drilling programs. And when they did, they dropped about 25% of the rigs that they had working. And they dropped those rigs over about a 4-month period, and then they held them steady. So gas rig count last year was reasonably steady up until the first part of May, then fell by about 25% over the next 4 months, May, June, July, August, and then September through December ran pretty flat as they adjusted their programs and carried on. Then this year, coming into the year, rig count stayed fairly steady up until about March. Gas rig count stayed fairly steady up until about March 1st. Then April and May have seen gas rig count come down by 15 to 20%. Till today, it's now running about 100 gas rigs each week. So we think that, based on last year's experience, that we've probably seen the bulk of the reduction in gas-related rig count take place. And it might go down another 5, perhaps 10 rigs from where we stand today. But I don't think we'll see much change. And our numbers, in terms of the forecast anyway, expects that the gas rig count figure will then hold steady through the end of this year. If we're right about our gas price forecast for next year, we think the rigs that have been laid down over the last couple of months in the Haynesville and in the Marcellus and so forth will re-enter the marketplace in 2025. And so we see a bump up in activity in 2025. We go from an average of 609 rigs this year to 623 rigs next year in aggregate. Over this whole period of time, rig count, oil rig count in 2024, we think will hold steady at around 500 active rigs each week, each quarter for the year as a whole. So not much change on an exit-to-exit basis when it comes to oil rig activity. We think there'll be a bit of a bump up in oil rig count next year over the course of 2025. So we'll go from an average of 500 oil rigs in the fourth quarter of this year to about 515 or so oil rigs in the fourth quarter of 2025. So about a 3% growth in oil rig count over the course of 2025. Again, on the gas side, we think gas rig count will be 100 rigs or so in the fourth quarter of this year, and 120 rigs or so in the fourth quarter of 2025. So over the course of that year, gas rig count we think will increase 15 to maybe 20% on an exit basis. So we have a bit of a bump up in activity for 2025, and that's all due to what we think will be a bit of a recovery in gas-related drilling. Oil-related drilling stays fairly steady across those years and stays very steady relative to the basins where we see oil drilling take place. Frac job count's a little bit different story, and it's an interesting reason why, I believe. So we've got frac jobs down about 13% this year, but up about 4% next year. But one of the things we're also seeing is that the average lateral lengths have continued to increase. And I think our next chart is one that sort of sets up that discussion. So here is where, out of one of our other reports, our frac and proppant report, we keep track of, make estimates of how much footage is being drilled through the reservoir by these horizontal wells. So it's sort of one thing to say, well, how many wells are being drilled, but knowing that lateral lengths are increasing, what's evident and important to note is that that the amount of footage going through a reservoir is gaining as well in this forecast. So while rig count doesn't necessarily jump up as a big growth area in 2025, we think there'll be a bit of a recovery in reservoir footage drilled, and this is not only important to our friends on the drilling side and their directional drilling services and so forth, demand for those products and services, but also on the completion side, right? Because the completion guys aren't driven so much by frac job count as you see on this particular chart, but rather how much footage is being fracked. And so the first thing it's got to do is be drilled, and then we frack it. So frack, because of longer lateral lengths, there's more reservoir footage being drilled. And what do we mean by longer lateral lengths? Well, so here's our average lateral length, as best we can tell anyway, by basin. And we go back from, as we start this chart in 2020 and go by quarter through the end of this year. And of course, what's striking is the progression toward average, in terms of average lateral length, how it continues to march upward and to the right across all basins, such that most areas today, or certainly most areas by the end of this year, will see an average lateral length somewhere between 11 and 12,000 feet. So if you put it all together for the U.S. as a whole, average lateral length is growing at the rate of about 5% a year this year. We think it'll grow another 5% in aggregate next year as well. It grew about 7% in aggregate last year. So this increase in lateral length is a continuing factor and has to be taken into account when we begin to think about demand for completion-related products and services. And of course, the devil, as Richard always says, is in the details. Here is the breakdown, last year's breakdown in terms of lateral length, where we put it into different buckets for regions of the country. So you can see each region has its own sort of profile out there. But the important, and so where the growth in average lateral length is happening is on the far right-hand side of each of these charts in terms of how many wells are being drilled that have 13 or maybe 15,000 plus foot laterals. Today, or I should say in 2023, these extra long laterals, 15,000 feet and more, accounted for just under 10% of the total wells, horizontal wells being drilled. Today, it looks like it's moving closer to 15% in 2024. So the average lateral length is increasing because we're doing more extra long laterals in the marketplace. Not that there's a big growth in the 3,000 to 4,000 foot lateral length bucket. That's not the case. It's that we're drilling, instead of a 10,000 foot lateral, a 15,000 foot lateral, or instead of a 12,000 foot lateral, 23,000 foot lateral. And so that is, so when we think about that on the completion side, yes, frac job count, measured in terms of numbers of wells, is going to be down this year around 13%. When you think about it in terms of increased lateral length and more reservoir footage, and then on top of that, something we've not got a chart here for, but where the spacing for frac stages continues to shrink, when we put all that together, the folks on the completion side will probably see activity measured in terms of volumes pumped or stages pumped, probably down only 4 to 5% this year. So yeah, frac job count may be down 13%, but some of these other measures of activity, like stages and volumes, will probably be only down mid-ish single digits as best we can tell. And of course that affects the market outlook for 2024 as well, because again, we continue to expect that lateral length will continue to grow and that frac stage spacing will continue to shrink. Canada is our other key market here, another one for us. And while gas has been the reason for a weakness in rig count here in the US this year, gas is the reason for the strength in rig count in Canada in 2024. And the issue there is not that prices are so great. In fact, they're not. Gas prices in Canada are just as down here, they're down sharply from where they were a year ago. I think they're down on the order of 20-25% relative to a year ago, seasonally anyway. And while gas prices may recover by as the year goes by, again, the whole inventory situation normalizes. The real key in Canada is the fact that operators are ramping up their production capacity in the Montney Shale in order to take advantage of the new LNG plants that are coming online, slated to come online over the near term, and export into the Pacific Basin. So, the chart on the right is our estimate of what gas production looks like from the Montney Shale versus all the rest of Canada, which is flat to down. But the Montney is going from not quite 7 BCF a day in 2020 to somewhere closer to 11 BCF a day come 2028. By the end of this decade, the Montney Shale will be producing somewhere between 60 and 65% of all the gas in Canada. So operators are really ramping up their production capacity, and that's the amount of drilling going on that is expected to see overall numbers grow about 4% this year, 184 rigs, somewhere just shy of 6,500 new wells drilled up in Canada this year. Now, what's interesting is that there's been recent news about a proposed cap that the Canadian government wants to put on oil production, which really a proposed carbon cap, how much CO2 can Canadian upstream operations release. And this is, of course, would materially impact oil sands operations up in Canada. Canada this year will see about a 250,000 barrel a day increase in oil output. Almost all of that's coming from oil sands. And another gain of a similar magnitude is expected for next year. So the oil sands piece is growing and delivering increased crude to the marketplace. And while they're making efforts to decarbonize that process, the caps that the government has proposed would mean that much less growth might be expected to come from the oil sands up there. So it's a point of contention between the industry and the Trudeau government. Like many other countries, there's going to be an election in Canada next year. The polls suggest that the opposition is ahead. So who knows if this cap will come into play or whether it will be sustained if there's a change in administration up there. But it is something I think we in the industry need to be alert to, because it will affect the pace of investment decisions on the part of oil sands operators up in Canada, at least over the near term until the political situation gets resolved. Finally, we turn to the international piece, which has been, of course, the shining star for the past couple of years, with North America down like it was last year. The international piece rose about 11% last year. I think our numbers suggest that rig count internationally will grow around 5% this year. So we end up with an average of around 942 active rigs, both land and offshore, something just short of 10,000 new wells drilled, and 73 million feet of hole. Now, these are international numbers, so excludes US, Canada, excludes China and Russia. But it does suggest that broadly speaking, the market will be going up. The chart on the right-hand side takes those numbers and breaks them down by region. 2024, the only negative region will be South America, Central South America, and that's really due to Colombia. Colombia's got the third most active rigs in that region. The administration there is really trying to push alternative fuels and has stopped approving exploration permits, and so that's really taken rig count down by 20% or more already this year, and probably further weakness ahead. So the Colombian numbers are the reason why the South American piece is down this year. The growth will, we think, happen in other areas. The leading particular zone will be in Asia Pacific. And then when we look at just the offshore part of the international market, again, onshore and offshore, we break it into the two components. So onshore market, we think will be up about 5% this year in aggregate, 750 average rigs, thereabouts, 7,500 wells per year. So roughly your average onshore rig internationally is drilling on the order of about 10 wells per year, as we can best estimate. On the offshore side, again, about another 5% increase, 195 active rigs as per the Baker Hughes count, and almost 2,400 wells drilled there. So slightly higher well per rig figure. That's because you got the advantage of platform operations, which in the shallow water development can drill in quite a number of wells annually, we believe. Rystad, interestingly enough, estimates that this year the deep water and ultra deep water piece of the offshore market is really going to sparkle. They've got about a 40% jump in the number of wells drilled in the deep water and ultra deep water category, exploration wells drilled in the deep water, ultra deep water category. So by their lights, they're counting 185 new wells drilled this year in those water depths. And so again, it kind of goes back to the point we were making about where's the oil production, the growth in oil production going to come from. Offshore, the deep water part of the market is moving from strength to strength as best we can tell. The only reason we don't have a more aggressive growth in the aggregate offshore rig count numbers is that the utilization of both jackups and drill ships is approaching 100%. It's nearly full utilization, and there's really not much expectation for an increase in the fleet for another 4 or 5 years, given the lag time in getting rigs built and so forth. So we're approaching a cap in terms of how many rigs can be employed, and that's one of the reasons, or that's the main reason why we don't see any more aggressive growth in the offshore count over the near term. And we break it down by market. Again, Central and South America down about 3% this year. Petrobras has announced that it wants to hold rig count fairly steady. It ended last year at 25 rigs, wants to add another 6 rigs this year, and then hold those numbers fairly steady over the medium term. Guyana's got even more, potential field development projects that Exxon is getting ready to approve. Suriname is another one that has where Total and Petronas have both enjoyed significant discoveries and are now trying to consider how they want to develop those. So we're going to hear more news there. I think at any one point, the international sector these days has about 250 projects that are from the pre-sanctioning phase to under development. Prior to the pandemic, there were maybe on average 300 or so projects in the queue. But today, around 250. The report that we issued in conjunction with this update mentions about 100 of those international projects. So you get a sense of who the operators are and what the project names are and sort of the timing on them as best they can be told right now. So we get a fairly broad picture that helps us make an estimate as to where activity is going, and when we look at the whole development process going on internationally. Europe fairly flat this year. Interestingly enough, the authorities in the UK estimate that last year they spent around 15 billion pounds in the upstream sector. The number is coming down to around 10 billion pounds under current policies. Of course, they've got an election where the Labor Party is favored to win, and Labor has got a more anti-industry attitude about itself. So that $10 billion pound number may be a pipe dream by the time we meet again in September, if the election goes as appears it might. Africa's up about 7% this year. Any number of countries, in fact, I think almost all countries in the area, as we see it, will have higher rig count this year than next. Namibia is the one that has caught the most attention. There's been discoveries made by Total and Shell, and the thought is now that the size of the discoveries are such that the scale of development will basically mirror what Exxon is doing in Guyana. So Exxon's got five projects up and running or in the development phase, 3 more to go. Same kind of outlook might be expected for Namibia, so we're told. Guyana back in Central and South America, Suriname in Central and South America is earlier on in the phase, but they've had some big discoveries too. And there's been no drilling yet, but southern Brazil offshore is attracting some attention because the basins in that part of Brazil are similar in nature to the conjugate fields on the opposite side of the Atlantic offshore Namibia. So I think we know where the rigs are going to be going to work over the near midterm in the offshore exploration world. Finally, we get to the Middle East. Slowed down, of course, because of Saudi's announcement that it would cut back capital spending, but it has said that it would maintain its roughly 300 rig fleet, and that any offshore rigs that might get dropped because of the cutback on oil development will be picked up due to increased gas development requirements. So we look for a fairly steady market over the next couple of years in the Saudi field. UAE is another one that has a number of projects. It's striking. If you look back to around 2010, 2012, there were only 12 rigs working in the United Arab Emirates. Today there's 72, 75, something like that. So it's increased by almost sevenfold over the last dozen years. So it really speaks to the nature of field development and CapEx in that particular country. Asia Pacific, like I said earlier, is up 10% this year. The leading star. Any number of deep water projects that are being pursued in various countries around the area. Australia, interestingly enough, has seen, under its current administration, has basically said that it will stop licensing. And the opposition party has said it wants to, if it were to take office, that it would reinstate the exploration licensing program that it had previously enjoyed. So Australia is another one where election results, I think, could hold a great import for what's the activity level of the industry. And then finally, we talk about China, up 1%, not much change. We think now that in China that there's about 1,000 or so multi-stage frac jobs being conducted each year. So a bit of an access point for Western oilfield service firms. Of course, the offshore sector is another one that's been active in China. And CNOOC has great plans to move ahead in terms of offshore output, and will be reliant on Western service firms to help with that process. So with that, I am now at the end of my slide deck. We'll take the next few minutes and talk about questions that have come in. And Richard will slide back in here and join us.
Well, let's take the one that Jeff just sent in, which is at what price of West Texas Intermediate does it take to reactivate drilling rigs in the United States? And I'm going to add the other thing, at what price natural gas?
So I don't think there's any price that does that.
For natural gas or for oil?
For oil, yeah. Because I think operators there are concerned about, you think about the mergers that have taken place. Much of that has been Permian-centric. And the reason for that has really been to build out the runway of undrilled prospects that these firms enjoy so that they can turn around to their investors and say, listen, we've got enough drilling activity. We're going to stay in business for the next decade. You don't have to worry about us, drilling ourselves out of work. Because again, the concern is if we step up activity, you shrink the number of years that prospect pile lasts. And so I don't think that I think instead what might be done is, again, this lateral length piece is, I think, the area that they're going to pursue. And so rig count, I think, stays fairly steady, but production, I think, can grow low single digits in that kind of a marketplace, and it just isn't a big driver of rig count.
You know, if I'm deploying one of our investment dollars, I'm going to deploy it in a way that creates feet of hole as opposed to a drilling rig.
Yeah.
Because I want to create I want to create 1 billion feet of hole more than I want to have the piece of equipment on the surface that creates the 1 billion feet.
Yeah.
So.
Yeah, I mean, there's obviously drilling days that are involved in longer laterals and so forth, but I don't think
shorter and shorter every year.
Well,
faster and faster.
Yeah, and that's because, again, those formations are so uniform that the shale section is the fastest, the quickest to be drilled, even though you're thinking that it's a long ways out in terms of rate of penetration. It's an easier task than trying to go vertically through a bunch of different lithologies.
Yeah.
Yep.
Yeah.
So
okay, here's another one. In your forecast, let's call it of spending.
Yes.
How much of that is as a result of inflation of the things that are being bought?
Yeah.
Versus, I think of it as changing the technique with which the wells are being drilled.
Oh, yeah. So
in the olden days, probably 20 years ago, the U.S. government came up with this way to help the oil and gas industry and help us. Refine the technologies to drill smaller and smaller, cheaper and cheaper holes.
Yes. Oh, yeah.
But the industry went the other direction, which is I'm going to gigantic holes, crack the heck out of them.
Coil drilling
and
down the whole line.
so it went the opposite direction.
Yeah.
So what do you think?
Yeah, so I don't see much change in unit prices. If I'm thinking about day rates, if I'm thinking about pump time, that kind of thing, utilization levels, asset utilization is usually what drives, the level of asset utilization is usually what drives unit price increases or decreases. And I just don't see, given our forecast, much change in asset utilization. So I don't think unit prices change very much. Now, there are input costs that will, drive inflation. So steel, for example, 2 years ago went nuts, and the industry had to, play along with all that. But
that reversed.
But that reversed.
And we benefit from.
Yeah, absolutely.
That.
So there's those kind of things. I don't think they have a big effect. So the design change thing is, I think, the key thing. When you think about a well that's now got 70 frac stages because the lateral is 15,000 feet long, as opposed to that's got 50 frac stages, which we thought was enormous.
I thought that was
when it was 10,000 feet long. That's the kind of thing that falls in my design change category, and clearly that'll drive pricing higher. So we've tried to allow for
it'll drive spending.
It'll drive spending higher. Yes,
it doesn't drive the price of a frac stage. It actually probably lowers the. I don't know. You get some steady state price.
Yeah.
I got sand coming out. I've got water coming out. I got chemistry coming out.
Yeah.
Let's do 10 more. Doesn't change the unit price of a stage.
So here's the other thing that is key too, and I think you have to factor that in somehow, and that is the fact that with these combinations, you got some, I think we have 6 now, maybe 7 operators to produce over 1 million barrels of oil equivalent a day here in the U.S. So you've got some enormous accounts if you're a oilfield service firm. And clearly those accounts can offer, volume, which we always know priced at a discount. You want to hang on to those guys. So that's the other thing I think that will play a role in keeping unit prices pretty flat. And really it's the design change piece that would drive the spending figure.
You want to talk about mergers and acquisitions in the oilfield service sector?
Among the service firms?
Yeah. I mean, there's a merger a week in the E&P side.
Yeah, a lot. Billions.
We look at the Raymond James, weekly update on M&A activity in the oilfield service sector.
Yeah.
And this week there was nothing.
Yeah.
It never is very many these days.
There's small stuff around the edges kind of thing. Yeah. So it's an interesting point, isn't it? I think there's maybe some capital coming back in. It might be credit. It might be private equity. there's in a fairly flat activity environment, then where are the opportunities for growth? Well, I think that's where the service firm has to now be about, can I add a piece here? Can I add a piece there that would allow us to, to grow going forward? Because it's going to be really difficult if you just stay stuck to your own knitting.
A really tactical investment.
Yes, for the very, yes.
Yeah.
And, those investments may or may not be U.S. focused. If we're right in terms of where the growth in activity might happen, then increasingly I think it might be an international piece that comes about. But I don't see it changing rapidly over the next 12 months. So, yeah.
Two-country presidential elections, one in Mexico, where they elected, I mean, who knew, a Jewish woman to be president of Mexico.
Okay. Yeah.
And in the fall, who knows? Do either one of those elections have an impact?
Yeah.
In the fall here?
Yeah, right. Yeah.
Do either one of those have an impact on drilling activity in either one of those two countries?
So in Mexico, the winning candidate, she didn't say very much about her energy policies. Broadly supportive of alternative fuels, but not much said about the oil and gas sector or Pemex specifically.
So nothing negative, nothing positive.
Yeah, just was sort of, now Pemex is highly debted, and there has been a proposal floated that says maybe the government takes on some of Pemex's debt so as to allow Pemex to then spend money on its various capital needs, which interestingly enough are really not so much Mexican oil production, but really in the refining sector for Pemex. Pemex is short of refining capacity. As much oil as it produces, it imports refined products. And so the thought is that may be a higher priority than putting more rigs to work in Mexico.
Let's turn the product into something that we can use.
Yeah. So, but we really just don't know very much yet. So the jury's still out here. Here in the U.S., as I see it now, if oil prices aren't driving activity in the U.S. like they used to, it's hard to imagine that anything happening in Washington is going to, rock the boat very much either. I mean, it will really drive activity higher or lower. I suppose there's always things that could have done, which, you give up the ghost and you go spend your money in someplace else. But I just don't see Washington as, because whoever wins the election, it's going to be, I think, a pretty divided government, and I think very difficult to move off the status quo with regard to regulations or anything else.
If you go to every oil and gas related event, conference, there's discussion in the hallways, at the tables, at the bar, about how the industry is going to wait until after the election to see what happens. And it's been that way for, the 45 years that I've been in the industry. Yeah. I agree with you. I don't think it matters. It's something we talk about. I don't think it's like talking about the weather. You really can't do anything about it. But, I think this shareholder and investor demands drive the behavior of oil companies, large and small. Yeah. And the elections are as they are.
Yeah. Clearly there was a lot of stuff that the Biden administration has done in terms of providing capital to alternative energy. And although interesting, hydrogen appears to be off the table as that those details have come out. Carbon capture might be benefited. So there might be some things around the industry that allow it to decarbonize. And coming out of Washington, that allow it to decarbonize, which I think would attract investment and just sort of help support activity. Because everybody wants their fuels to be cleaner tomorrow than they were today, and so that may be something where both parties can reach agreement and move forward on. But it's only that kind of stuff, I think, that really I see having an effect that comes out of Washington, or maybe even 2020.
Any last comments? We have other questions, but we've run out of time.
We will be back here in September. Every 3 months to update, as we always are.
Whether we want to or not.
Oh, no, we want to.
Oh, that's right. We want to. That's right.
Like I said, Pat Sajak may be out of a job now, but I'm still going. So,
Who does that make me?
Yeah, Vanna. We'll be updating it. The numbers officially come September. If between now and then you have any questions about things, of course, we're always happy to respond. So reach out by phone, email, or to myself or Richard.
Telegraph.
And we will respond accordingly. Until then, best wishes for one and all.
Happy trails.